welcome to the special edition of the Global View with me, Tanvir Gill. My guest today on the show is a lady who is one of the most respected and influential economists and strategists on Wall Street. With her career spanning more than 4 decades, she's perhaps the best placed speaker to make sense of world markets and the uncertainty that lies ahead in 2017. Abby Joseph Cohen, president of Goldman Sachs Global Market Institute, joins me all the way from New York to discuss her world market outlook. Abby, it's great to have you on the show. Thanks very much for taking out the time. First up, Abby, you were optimistic on the U.S. markets through June and September 2016, even before the Trump rally took the Dow higher by 10% plus for the year. In that way, you were ahead of the curve with your view. Are you still as bullish on U.S. stocks as you were in October?
The optimism in 2016 was based upon the idea that the U.S. economy was performing well and the risks were to the upside. As we start 2017, the U.S. economy is still performing well, in some instances even better, with GDP growth now accelerating. However, the risks now may be to the downside. We can certainly do estimates for where the economy and the markets may go based upon estimates for GDP and corporate profits and so on. But the risks are geopolitical in nature. We are obviously going to see significant changes in policy here in the United States, but we also see a period outside the United States of less stability in which things might be changing. I'll just point out that there are upcoming elections in France and the Netherlands, and we will all be waiting to see what the impact is of that, plus, of course, the Brexit negotiations this spring and summer.
Abby, after President-elect Trump's press conference, there's just one question on everybody's minds, and that is, under the Trump administration, what will happen to the U.S. markets and the underlying U.S. economy? Does one, in the wake of uncertainty, brace for a more volatile year in 2017 than what we witnessed in 2016?
We do think it will be more volatile. Keep in mind that measures like the VIX, standard deviation of price change, have been running at fairly low levels. We think that will pick up, number one. Number two, as I mentioned before, there is this broad blanket of geopolitical changes that are very hard to forecast and very hard to quantify. And the third thing that we believe is that the very high correlations of returns within the U.S. markets, in which many stocks move together, we think that that will break down a little bit in 2017, in which the benefit will be to those who can actively select securities. So not just focusing in on the indices like the S&P 500, but on individual stock names. And by the way, similar conclusion in the bond market. If interest rates are going up, as we think they will be doing, because of what the Fed will do and because we think inflation will be moving higher, that's not good news for bonds in general. But we think that good bond selectors, people who do research on individual securities, may find some opportunities.
Another growing view, Abby, is whether or not the U.S. is in a new structural bull run. Some argue that this could be just a sentiment-driven rally, given the perception that Republicans have been good for business. The GS 2017 equity outlook also talks about fear giving way to hope. My question to you is essentially that come March 2017, the U.S. markets will be completing 8 years of a bull run. How do you compare that to, and you're perhaps the best place to answer this, how do you compare that to the super bull cycle that the U.S. markets witnessed in the 1990s, which spanned 9 years? Where are we in this cycle, and what does that mean for further upside from these levels over the course of the next 12 months?
I'm glad you mentioned that this bull market began so many years ago. And in that first phase, much of it was driven by PE multiple expansion. When it began in 2009, PE ratios were about 8 times earnings for the S&P 500, and we're now about 17 times earnings. So the question for the next phase has to do with 2 things. Number one, profit growth. If profits continue to grow, even if PEs don't expand further, you would expect stock prices to rise, which is why I gave you the expectation that at least in the first few months of 2017, stock prices will move higher. But the other thing has to do, as you correctly point out, to structural changes and also the durability of the economic expansion. If investors have confidence that economic growth will continue not just in 2017, but also 2018, share prices can continue to move higher once investors begin to price in that 2018 outlook. One of the questions that we have for spring and summer 2017 is whether investors will be comfortable doing that. That is, flipping the calendar a few months before we're actually into 2018, and much will depend not on the economy and not on corporate performance, but rather on the performance of political actors in our nation and others.
Right, but in this hope versus reality trade, what is the market expecting in terms of the drivers that will lead to a strong and sustainable economic recovery in the US? So we know that growth is picking up, we know that the jobs market is looking healthy, we know that inflation is likely to rise through the course of the next 12 months. But what will keep the momentum going?
Long-term economic growth in any economy is very much related to productivity of workers, and that in turn is related to investments that are made. And speaking as an economist for just one moment, those investments have to fall into two different categories. One is labor. How are we educating people? Is our workforce growing, for example? And the second has to do with capital and investment in innovation and R&D, and dare I say this, public infrastructure. And so one of the most important things we'll be looking for out of the new administration is whether they will be putting in place new economic policies that will enhance not just the short term, but the intermediate and long term. And right now, the jury is out. We do not yet have answers because we have not yet seen a conclusion that has been reached, an agreement reached between the incoming Republican president and the Republican Congress, and we certainly haven't seen the legislation. I would make one observation about the rally in 2016 post-election. When we speak to investors, they were focusing in on two different things. One has to do with the change in the regulatory environment in some industries. The other had to do with the expectation that corporate profit tax rates would be coming down in the United States. Let me just point out, we don't yet know how either of those things will be accomplished. While it's true that the United States has a high statutory tax rate, that is a 35% tax rate federal and another 4% or so at the state and local level, the effective tax rate is not that high. For the S&P 500, the effective tax rate is closer to 30% or lower than it is that 39%. And so when we talk about a lower corporate tax rate, yes, the statutory rate may go down, but we also need to look at the other changes that may get made that would take away some of the tax credits and other benefits companies are now enjoying.
Avi, that just brings me to my next question, which is essentially the potential risks in the market in the new year. You know, after 7 years of QE, is there still a case to think that there are no excesses in the system waiting to blow up? For example, an overbought bond market. We've had Bill Gross come out and say that he's bearish on bonds. Could there not be a ticking time bomb as rates go up that can impact sentiment and lead to a major sell-off in the bond market, and that could spill over into impacting sentiment for equities too, sooner rather than later?
And that phrase you used is critical, sooner or later. And what we know, at least from U.S. stock market history, is that there can be an extended period in which interest rates are rising, i.e. bond prices are falling, but interest rates are rising at the same time that stock prices are moving higher. And that happens when interest rates are moving higher because the economy is performing well, and the feeling is that the central bank no longer needs to provide that monetary stimulus. And we think we will have that sort of environment in 2017. We expect the Fed to be raising interest rates 2 to 3 times during the course of this year. We have plugged in those higher interest rates into our equity valuation models, and things still look okay. But there's another point that you raise that I'd like to address, and that has to do with the amazing amount of monetary policy stimulus in recent years, not just in the US, but around the world. And I believe, in many cases, it has been overdone. Overdone in large part because fiscal policy was absent. It was only the central banks that were trying to step in and provide some sort of stimulus. And as a consequence of that, I think that interest rates are currently below equilibrium. That is, they're lower than they should be. And we see that bond yields are likely too low and therefore moving up, not just in the United States, but in Germany and many other important countries with large fixed income markets. And I also believe, and I'd like to state this clearly, that the use of negative interest rates will prove to have been a folly, a huge mistake. For example, a number of European countries have moved to negative interest rates, and it has had unintended consequences. Instead of encouraging consumption, it is encouraging saving, because as those populations get older and approach retirement years, even if the returns in a bank are not positive, they're negative, people are afraid to do anything but to try to build up their savings. In addition, while some central banks and some governments claim that the use of negative interest rates has supported economic growth, I would urge them to take a look at the mechanism by which that actually worked. I think in most cases it wasn't the negative interest rates directly, but rather negative interest rates leading to a currency decline relative to the dollar, and therefore growth improving because exports to the United States increased. That is not a long-term sustainable policy in my view.
But Abby, don't you think the markets are not as worried as they should be about a super expensive dollar and treasury yields inching past 2.6%? These were the two factors that spooked world markets at the beginning of 2014 and 2016.
I believe they should be more concerned than they are. And the strong dollar is a problem in many different ways, but let's take it from the standpoint of the United States. If our currency is a very rich currency, that makes it more difficult for us to maintain our trade. Over the last 10 years, the single fastest growing sector of U.S. GDP has been exports. And so if we have a dollar that is very high, that is something that impedes economic growth. And there's a secondary factor as well, and that is the so-called currency translation for corporate profits. In the S&P 500, about 40% of profits derive from activities outside the United States. When those profits get translated back to dollars, if the dollar has risen in value, those profits are worth less. So it becomes a significant issue. We also would point out the following. A currency is a relative price. It's not just the price of the dollar, as you correctly noted, it's the dollar relative to something else. So the dollar has gone up in value in part because the United States economy is stronger, growing faster than many others. And so that strong dollar in many ways is a difficult sign. We also know that yields have stayed lower than many people expected. We think the equilibrium yield on the 10-year Treasury bond is about 3% relative to the current 2.6. And while it has moved up notably in recent weeks and months, it's still below equilibrium. Why has the U.S. Treasury yield stayed low? One of the reasons is the strong dollar and worries outside the United States about other people's banking systems and so on. So we continue to see significant foreign demand for U.S. Treasury securities.
Okay, Abby, let's talk about growth trends then. Do you believe that growth averaging between 2–2.5% is a new normal? Because if we compare this growth trend to what happened in the previous bull economy, in 2004, 2005, then growth at that time peaked at 3.5%. So we're looking at rates being hiked at a time where optically growth may seem subpar. What's your own perspective on this?
Our sense is that 2.5% is probably an equilibrium growth rate now for the United States. In years past, when we were closer to 3%, we had faster growth in our labor force, we had higher productivity growth for our workers, and so on. And so 2 to 2.5% we think is sustainable, non-inflationary growth for the United States. Contrast that to Europe, which is closer to 1%. And the numbers there are lower because labor productivity is lower and labor force growth is much lower as well. So when central bankers and other policymakers take a look at what can be done when the economy is growing 2.5%, and by the way, on average, has grown 2 to 2.5% since the financial crisis, and capacity utilization is already at high levels, and the labor market is already approaching full employment, we would suggest that policymakers need to be careful about trying to push that growth rate higher because it could in fact create unwanted inflation.
Avi, let's also talk about Europe. The key risk for 2017 is Brexit, and once Article 50 gets triggered end of March, while it's going to be a 2-year negotiation period, the market particularly will be watching out for whether or not the UK can retain its single market access. What do you think about the risk and its impact for the region and for the rest of the world over the course of the next 12 months?
It's not just Brexit. It is those movements that are referred to as populist movements, not just in the UK, but in other economies as well, that will tear at the fabric of public support for the EU and the Eurozone and so on. And that's what we'll be watching carefully. As mentioned previously, the elections upcoming in France and the Netherlands and some regional elections in Germany might give us more information. But what we are seeing that is troubling is this idea that perhaps the way the world has structured the global economy since the end of the Second World War may be in the process of fraying. I didn't say breaking, I said fraying, in which it's no longer viewed as something that is worthwhile to encourage cross-border flows and so on. Let me point out that there is a very significant tension in the following way, and that is we have politicians talking about becoming more nationalistic at the same time that many corporations in the 21st century have really moved towards the idea of global supply chains, global employment supply, and so on. And those two things may in fact be at odds with one another.
Fair enough. Abhi, we have to talk about emerging markets and India in specific. We have a budget coming up in early Feb. At a time where governments across the world are stepping up on spending to push investment, what are the 3 factors that will draw more interest from global investors to India within emerging markets through 2017? GS believes India holds promise from a policy-making perspective. Explain that.
That's a very interesting point that you raise. Clearly, my colleagues who focus in on the emerging markets do believe that on an intermediate to longer term basis, India represents extraordinarily good opportunity. Some of this has to do with things that are not looking so good now getting much better. So, for example, in forthcoming years, we do expect that there'll be within the, let's call it the legal sphere, less bureaucratic entanglement. The court reforms are helpful, accounting reforms are helpful, and so on. Secondly, in a world in which labor force growth has slowed dramatically, and in some countries, including emerging economies such as China, it's funny to refer to the world's second largest economy as an emerging economy, but we're talking about economies where there is no labor force growth or population is actually shrinking as it is in Japan and in some places in Europe. India is really a standout in that regard. You know, long-term economic growth is related to a host of factors, but very importantly, growth in the labor force is critical. We also think there'll be an improvement in the literacy rate in India. So my colleagues remain quite optimistic about India. We see an equilibrium growth rate, let's call it in a range of 7 to 8%. Contrast that to 1% for Europe, 2 to 2.5% for the United States. So that represents attractive opportunity. In the short term, many non-Indian investors are looking at the demonetization effort with great interest. Something that most of us are not familiar with because it hasn't happened all that frequently in world economic history. But the data thus far suggests that things are going about as planned. And we think in 2017, 2018, what will emerge will be an India that seems to have a greater transparency in terms of what's happening in the economy. This is just one of several reforms that have been discussed by Mr. Modi.
Also, Abby, how do you look at monetary policy action in emerging markets responding to the monetary policy stance taken by some of the developed world economies, starting off with the United States as they move towards policy normalization? Can EMs continue to be accommodative if the Fed turns hawkish, and that's followed by the ECB using the exit towards accommodative monetary policy and the Bank of Japan following suit?
Let's keep in mind that what happens in the United States may be unsynchronized with what happens elsewhere. The United States economy has grown faster and for longer than others. Capacity utilization rates in factories and in our labor markets are far different than they are in Europe. So, for example, our unemployment rate is closer to 4.5% as opposed to the 9.5% that we see throughout much of Europe. And so the rise in interest rates that we expect in the United States is something that I would not describe as contractionary, but rather less stimulative than it was previously. Because we are coming from interest rates that the vice chair of our Federal Reserve has referred to as very, very, very low. And with the rise in rates we've seen, they're still very, very low. We don't think they will impede economic activity, and we don't think that it will afflict the United States in its role as a very significant importer of goods from other nations.
As a broad theme, 2017 is seen more advantage United States, disadvantage emerging markets. Is that your view as well?
I think it is so important to recognize that while it's easy to say emerging markets and assume that the average of EMs tells you something, it really doesn't. There are such extraordinary differences between the various economies. You know, we spoke a little bit about India, and what we see in India is dramatically different from what we see in East Asia and what we see in Latin America and so on. And so, number one, we need to look at each economy and each market separately. Number two, even if I break my first rule, I do think that emerging markets can have a reasonably good year if the United States has a reasonably good year. If the world's largest importer continues to grow, if Europe enjoys a somewhat above average 2017, this is good news for many of the emerging markets. But we have to be careful to separate them in terms of those that grow because they're commodity producers, those that grow because they have significant cost advantages in manufacturing, and others that benefit because of where they're located geographically. There are so many disparities between emerging markets that I hesitate to discuss them all as one large group, other than to say that if investors are not risk averse, if investors globally are willing to take on risk by looking at areas of economic growth, then emerging economies and emerging markets should do well.
Well, that's a fair point. Well, thanks very much, Abby, for taking out the time to speak with us today. Really appreciate
Thank you.
Your views and your insights to world markets. Well, with that, we come to the end of this special edition of the Global View with Goldman Sachs. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.